Awesome. Okay. All right. So welcome back to tonight's class. And we are continuing on life insurance, chapter 7 to chapter 12. Fingers crossed. And we are diving straight tonight into the taxation of universal life. Okay. Recall yesterday we talked about, life insurance. A quick recap is that life insurance is about taking care of risk, okay, the risk of one dying. And there are different ways we can take care of those risks, okay? We have permanent risk and we have temporary situations. So the temporary situations can be addressed with temporary insurance, which is, in other words, called term insurance. And the permanent situations can be addressed using permanent insurance. And we also discussed the fact that when it comes to
you're not
permanent
sharing your screen.
insurance, no, there's no screen to be shared. Take your notebook and your pen. Okay?
Oh.
Yeah. Because that's why your study, your text, because some of you have Oliver, some of you have Remix, different materials. So yeah, I'm just explaining the principles. The note I have here is the one I have noted down. Okay. So do you guys need a minute or two to get your pen and paper ready?
Yes.
Okay. I'll pause recording. We have a long to cover. So as I was saying, the permanent situation will have to address with permanent insurance. And we did discuss that the permanent insurance are three of them. We have the whole life, the universal life, and the 10 to 100. And we unpacked all the three of them yesterday. So tonight, we are looking at the taxation of universal life. Okay, how is universal life taxed? If policyholder dies, the death benefit is completely tax-free. But between the time the policy owner takes the policy, should somebody is there's an echo. Okay. So between the time a policy owner takes a policy and the time the person passes away, if the person cancel the policy or abandon the policy, you guys remember we talked about that yesterday, right? And that the word used is disposition. Okay. But I'm the one that use the word abandonment so that we can use it to remember. So anytime you see disposition, anytime you see the word disposition, is speaking to a situation whereby somebody said, I'm not doing again. That's what that is referring to. Okay. So now, if somebody cancels their policy or surrenders the policy or withdraws cash from the policy, okay, or takes a policy loan, or if it's a participating whole life that pays out dividend, or a policy becomes non-exempt, these are circumstances that can potentially trigger taxes in universal life policy. All right. Now, let me explain each of these for you guys. Number one, death benefit of life insurance, be universal or whole life, is tax-free. However, when somebody cancels policy...
It seems you have stopped recording.
Sorry?
It seems you stopped recording. I just wanted to find that out to you.
Is he recording?
It's recording.
It's recording.
Yeah. See, if somebody cancels their policy, especially with universal life, okay, that policy may have cash value at the time they are canceling the policy. So the fact that they cancel the policy does not mean the money in their cash value is not theirs. It's theirs. So that may trigger taxes based on the adjusted cost basis, ACB. Okay, so cancellation of a policy can trigger taxes. Now, policyholder surrendering all or part of the policy can also trigger taxes. Now, if the policyholder withdraws from the investment amount in the policy, that can trigger taxes also, again, depending on the adjusted cost basis. And we are going to look into that. Now, participating policy pays out dividend. Now, policy becomes non-exempt. See, when policy becomes non-exempt, that can, expose the policy to taxes. And what is non-exempt? Non-exempt, there's what we call exempt test. Okay. Okay. Let me show you guys. For those of you in the class yesterday, you recall how we did it, right? We see some of these things real time in the illustration software, and that kind of aided our knowledge to a great extent. And I tend to do the same again today. Okay, so let me put this in. Okay, can you guys see the software? Hello?
Yes, we can see it now.
Yes,
Yeah,
we can see it.
Yes, we can see.
Okay, so this is the exact software we used yesterday. So you see how there's this bubble here. It says exempt test increase. Can you guys see it where my cursor is, right?
Yeah.
Now, you see, so this exempt test increase, all right, is what we are talking about. Now, every time you are running illustration for somebody, you have to ensure that you are using either exempt test increase or use increase and decrease when it comes to exempt test. Now, what is this exempt test? Exempt test, okay, it's like a lead. Let me stop sharing. It's like a lead, okay, put together by the insurance company. So when you select that button, you activate it, you set it in motion. So let's say market is doing very well, especially with universal life. Universal life is not capped by any this thing. Like we saw yesterday, market deliver 50%, the client is getting 50%. If market go crazy and return 80%, the client is getting that same 80%. So that may lead to a massive growth in the policy. And of course, when that happens, CRA will come knocking. But when we activate the exempted, is set like a lead. So whenever there is a growth, a massive growth in the policy that is going to a point that is going to trigger taxes, that thing will notify the insurance company. Then what will the insurance company do? They will reach out to the client and tell you, you have so much money in your plan. Then the insurance company will show you different strategy. Either you withdraw some money or you increase your coverage and different stuff like that. However, if there's no that exempt test increase in place, the policy will grow, boom, the next thing, the whole plan will be exposed to CRA for taxes, okay? So that exempt test increase is a very powerful tool. It's like a gatekeeper. That's the right word. It's a gatekeeper, all right? Okay, so another situation that can trigger taxes in universal life is, we've talked about exempt test, then policyholder absolutely assign or transfer ownership of the policy to another person. You see, that is if the policyholder assign the policy to another person, that could trigger taxes. And then if the policyholder dies and is not the life insured, such that ownership of the policy is transferred to another person, that may trigger taxes. Recall yesterday we talked about the fact that how we have different parties to insurance contract, right? We have the life insurance, the policy owner, the life insurance, the beneficiary. So in a situation whereby the life insured is different from the policy owner, and then the policy owner passes away, then the ownership now is transferred to another person, that may trigger taxes, depending on the circumstances of the transfer. Okay, So moving on to the concept of taxation of policy, we are still there. But now let me give you a typical example and hold your pen. Okay. Now, you have, let's say you bought a house, okay, for 200,000. Write it down. You sold that house, okay, for 300,000. How much is your profit?
100,000.
100,000. 100,000. Okay, so that is your profit. Now, anytime you hear ACB in this course, they are talking about the profit. ACB stands for adjusted cost basis. When you hear ACB, think about cost, sales minus purchase price, okay, equal profit, Abi. So that is referring to your ACB. Profit on what you understand me? That is the difference between what you buy, so how much you bought something and how much you sold something. You look at it this way. Let's say you take insurance company, you've paid for it for 10 years, Abi, and in that 10 years, the total amount you have contributed is 50,000. Right? And because this is universal life, your cash value now is 150,000. So if we were to do your adjusted cost basis now, your adjusted cost basis will be how much?
100.
100,000. You see, that's your adjusted cost basis. Okay? So if you say, oh my God, I have 150, and you withdraw that 150, that may trigger taxes. So this is what this chapter is trying to open our eyes to see, so that we don't walk into the den of CRA unknowingly, and then boom, we'll receive CRA will slam us tax or slam our client tax. So the knowledge of this will enable us to guide our client appropriately. Okay. So a typical example here is this. Brian surrendered his whole life insurance policy and received a proceed of 46,000. Write it down. He received 46,000. The insurance company advised him that his adjusted cost basis ACB was 20,000. So he has a policy gain of 26,000. And 100% of this was taxable. So basically, what is the maths behind this? This story now, how do you put it in mathematical form?
Can you come again?
Good job. So Brian, okay, received a proceed from his insurance policy of 46,000.
Okay.
Okay, and the insurance company advised him that his adjusted cost basis was 20,000. That is the total amount he's contributed
over time.
Over time is 20,000. So how much is his policy gain?
26,000.
26,000.
26,000. 26,000. Are we
How is
following?
that? No, wait. How is that? The policy is total policy.
No,
is
no.
46,000.
Hello, ma.
Yeah. Hello.
I believe it's it should be 66.
No, it's not 66 because you are reducing, you are deducting the 20,000 from the 46,000.
Yeah, sorry, ma. Yeah, sorry, ma. 26, ma. 26.
This 26,000 is his policy gain. 26,000 is his policy gain. Okay.
Sorry, can you read that question again, please?
Oh, yes, 100%. Brian surrendered his whole life insurance policy and receives a proceed of 46,000.
Okay.
Full stop. The insurance company advised him that his adjusted cost basis was 20,000. So this adjusted cost basis now is the total amount he's contributed over time. Over the course of that life insurance was 20,000. So he has a policy gain of how much?
26,000.
26,000 is his policy gain.
Okay.
So
what
now
is
he'll be
ACB?
taxed.
ACB
Okay.
is
ACB stands for adjusted cost basis, and we are going to look into that because ACB is another humongous section on its own, because there are different formulas for ACB depending on whether they are grandfather policy, which covers certain years to certain years and stuff like that. But don't worry, we are going to explain it in a way that you will not be confused. Okay.
Why?
Go
Sorry,
ahead.
ma. Can I ask a question?
So
Yeah.
you want us to know how much is his total that he has contributed?
No, what we are looking here is how much is his policy gain.
Policy gain.
The ACB is the total amount he has contributed, and they have told us that his ACB is 20,000. So they've given us that his ACB is 20,000, and then the proceed from the policy is 46,000.
Okay,
so if we take
now. 46
sorry,
minus 20 is 26.
26,000 exactly.
Yeah.
Okay. Yeah. So now there are factors, okay, that affect adjusted cost basis. Okay, there are factors that affect adjusted cost basis. Now, for those of you that are writing, this is a very, very this is topic that you don't want to play with. This is a topic that you want to take advantage of this class to understand it. Because when you understand it, there's anyhow the question comes, you will be able to unpack it. Okay? So now, when it comes to participating whole life policy, okay, for those of you that are in class yesterday, we talked about whole life being divided into two. We have participating whole life and non-participating whole life. When you hear whole life, participating whole life, for the sake of you that were not in the class, is the whole life that pays dividend. So just look at it like you are participating, you are part of the company, you participate in every goodies that the company have. So that is, those are the ones that receive dividend, okay? Non-participating whole life is the ones that do not partake in any goodies, that is, they don't get dividend. Understood? Good.
yes.
So now, for participating whole life, dividend used for paid up additions or additional term insurance or repay a policy loan. Dividend, wait a minute, dividend paid out. Okay, so they are telling us that how does this affect your adjusted cost basis? Okay, if you use your dividend to pay up addition or to buy additional insurance, okay, so the money is not coming into your pocket, the money is going back. So it's not going to be taxed in your hand because you are using it to pay up your premium, and you are using it to buy up additional policy, okay? Then also your dividend that you use to pay out a policy holder in cash, that one will be deducted, okay, from your ACB. However, the one you use to pay off for your policy or to buy additional policy will be added to your adjusted cost basis. How does this play out? I will explain.
If you just said that if I use my dividend to buy more shares or to increase my premium.
No, to pay up, if you use your dividend to pay up, pay up addition or additional term insurance or to repay a policy loan, it will be added to your ACB. And if you take it out in cash, it will be deducted from your ACB.
So if I withdraw it in cash, it will be taxed.
Okay, you are going ahead. Stay where we are right now. Right now, we are talking about your ACB, your adjusted cost basis.
Okay.
Okay. Remember, your what's it called? Let me put that up here. Your insurance proceed minus your ACB, okay, is what gives your the profit you've made that TRA will tax. So ACB is the driver here. Make sense?
Okay, that means they're going to tax the 26,000 that I made.
Mm-hmm.
So they are not going to tax. They are not going to tax my actual premium.
No, is the profit. And how is the profit that you make determined? Remember, the premium that you pay is your after tax, because insurance premium is not tax deductible. So if they tax the premium that you contributed, it means that it's unjust and unfair on CRA to double tax you.
Okay.
And that's the whole essence of this chapter. How do we determine that after-tax money you used to contribute, to pay premium into your policy, and the profit you have made?
So my premium, my premium over time will not be taxed, but the profit that I've made will be taxed.
So the total premium you contributed will not be taxed. But because there are different dynamics to universal life and whole life, how do we determine those adjusted cost bases so that we'll have a fair determination of profit that you've made that will be taxed?
Okay, but if I hear you clearly, you say something that there's a way that we can advise a client that even the adjusted cost basis will not be taxed, provided you invest it in your policy.
Okay. You know what? Let's go step by step, okay?
Okay.
Yeah, let's take it step by step. All right. So now at this step where we are now, okay, let's say Mr. A have a policy, and in this policy, he has had this policy now for 20 years. Okay. And for 20 years, he contributes $100 every month. That is 1,200 times 20. How much is that?
1,004.
Sorry?
24.
No.
1,200
1,200
times 20.
Yeah.
240.
24,000.
24,000, yes, now. It's 24,000.
24,000.
24,000.
That's 1,200 times 24.
20.
Okay, 24,000. Okay. So in 20 years, Mr. A have contributed 24,000 into this policy, right? And in these 24 years, okay, for participating whole life, Mr. A received, let's say he received 1,000, what is it called? Dividend. Now, this 1,000 dividend, let's say he receives 2,000 dividend. for this 2,000 dividend, he used 1,000 to buy additional policy. And then he collected 1,000 cash.
Okay.
All right. So the 1,000 that he received, that he put back into the policy, the dividend used for paid up addition or additional term insurance or to repay a policy loan will be added, okay, to his ACB. So we are going to add this 1,000 to the 24,000. That will give us what? 25,000. However, Mr. A received dividend paid out to his policyholder in cash of 1,000. So we are going to minus that 1,000 because he received that in cash.
So where are we minusing the 1,000 from?
We are minusing it from the total amount he's contributed. Remember, I told you he pays $100 every month for 24 years, and we got 24,000. For 20 years, we got 24,000. Sorry, for 20 years, we got 20,000. And then he received 1,000, which he did not take out in cash, but he put it back into the policy.
Yeah.
In a paid up addition. So for those of you that are wondering what is paid up addition, what is dividend, don't worry, when you watch yesterday's video, you're going to understand it. So we're going to add that to it, and that's how we have 1,000. But because this 1,000, he received it in cash, he has collected that one. So we are going to minus that.
So now he collected 2,000 and he plowed back 1,000. So that makes it 25,000.
Yes, that makes it 1,000.
So the other 1,000, he collected it in cash.
Yes, so that will be deducted from his ACB.
So that will be deducted from the ACB. ACB being the profit.
No, ACB is the adjusted cost basis. Okay, what does it cost you? What it has cost you
contribution over time.
Benny, that is it.
Okay,
yeah,
so that means now
1,000
from that 25,000. So it will now go back to 24,000.
Exactly. Because technically, see your ACB as what you have put into this thing over time. Because he collect, he didn't put the 1,000, the 1,000 he withdraw, he takes it and it's not part of this thing.
Okay.
So that's why we are deducting it from there. Now, how about policy loan? So just follow me. If you understand all this stuff, but this is taking us time, it's okay. But my joy is that if you understand it, anywhere the question angle it comes, you will unpack it and you nail it. You got it?
Okay.
Sir Joy.
Yes, ma'am.
I'm having some confusion there. From the first illustration you give, you say the proceed was 46,000, right? And the ACB was 20K. So when you minus the 20 from the 26, his policy gain, that's the profit he made will be 26,000.
Right? You got it, my yes.
Yes, but in this very one, now this last illustration, you said as in, let's assume as in that it was paying 1,200.
Let me stop you right there. Okay. So you see that first illustration with Brian is a straightforward illustration. You know, you put this, you get this. You know, it's just like very, very direct, right? But what if your question is not direct? Now they are throwing in salt, pepper, Maggi, whatever spice you can use to cook inside one question. So we need to understand the different components that can form a full package question. You get what I'm saying? So your understanding of the previous is correct. Now we are saying, taking it another step further, that, okay, now for this one, maybe we continue on that, using that brine 46,000. Okay, let's continue with that 46,000. Now his proceed is 46,000, right? Now we have not heard that his ACB is 20K, right? That is how much he has contributed into the policy over the course of the period, right? But now they came back now to tell us that, we forgot that we pay out dividend to Mr. Brian. What's his name, sir? Yeah, to Mr. Brian. He took 1,000 and used it to buy a paid up partition. Aha, we're going to add that 1,000. We see that he also withdraw another 1,000 in cash. So we add this 1,000, it becomes 21,000. Then we are going to minus the 1,000 he collected in cash, and then it become another what? 20,000, which we will now minus from the 46,000. Okay?
Okay.
Get it now?
Yes.
Okay. So now we are moving on to policy loan. So anytime you see where there is dividend and somebody take it out in cash, just know that you minus it from their ACB. Okay. Now let's move on. What is the impact of policy loan on ACB? Okay. So interest paid on policy loan. Yeah.
Mr. John, yeah. And that's the cash value of 1,000 that was taken. It attracts and it triggers tax, right?
So that is why we are minusing it from his ACB.
Will it be taxed?
That is not what will be taxed. What will be taxed is the profits. Okay. So let me show you guys the impact now, because CRA know what they are doing. So because we have minus that, okay, from the 21,000, all right. So his policy distinct is now 26,000. Policy gain is 26,000. However, if we had not minus that from his policy gain would have been how much?
27.
No.
28.
25.
25.
25.
25. He would have paid less taxes.
Okay, so that means okay.
Yeah.
Okay.
Why would it be 25? He had a gain of
20.
He had a gain of 26,000.
Yes.
No, because see, if that 1,000 that he took out in cash was not deducted from his ACB, then his ACB would have remained 21,000.
Yeah.
And it would have been that 21,000 that we would have deducted from the 26,000, which would have reduced his profit and potentially reduce how much he will pay in taxes.
So what are we trying to achieve by doing this?
What we are trying to achieve by doing this is that we are trying to establish the exact amount that he invested into the policy.
Okay, so you just want to be sure that the policy is investing is intact. It's not reduced.
No. We just ensure that he is not making, he's paying taxes on what he should be paying taxes on.
Okay,
No more, no less. Okay? This chapter 7 deals on taxation on life insurance. Okay?
Okay.
So now we are looking at policy loan. Interest paid on a policy loan, unless the interest is deductible as a business or investment expenses, is added into the ACB, that is total premium paid. This is simple logic, right? So if it's not a business interest, for example, you take a policy loan, right? And you are paying interest on that policy loan. So it's additional expenses for you. So that will be added to your ACB.
Okay, policy
Just
loan.
know that
Policy loan is
interest.
policy loan is when you have used your premium as a collateral.
No, when you borrow from your cash value.
Okay, you borrow from
collateral,
your cash value.
Yeah, you borrow from your cash value. You see, notice that they higher your ACB, they lower your profit, and they lower your taxes.
The higher the ACB,
they higher your ACB, they lower your profit, and they lower your taxes. Oh my God, you guys.
You are it's like you are getting more confused. Higher ACB and profit, I believe is the same thing.
Your ACB is not your profit. Your ACB is the total amount of contribution you made over time into your policy.
That's the premium, right?
Yes, that is the premium.
Okay, so the profit now is what comes after maybe your policy is sold, or the value, the market value. Is that it?
Yes, the cash value in your policy is known as the total. You can use the word profit in your policy, but you cannot say profit, because the total amount in your cash value is not your profit until you remove how much you've contributed into the policy over time.
Okay.
For example, if you have 150 in your policy, if you say that 150 is your profit, CRA will charge you taxes on 150. But that will not be fair to you, because in that same policy, you probably have your total premium over time may be 50,000. Your 50,000 after tax money. Right?
Okay.
So we need to remove that 50,000 from the 150 to get your profit.
Okay.
You got it? I use an example. You bought a house. You bought a house $50,000. You sold that same house $150,000.
Okay.
How much is your profit?
100,000.
Is the $150,000 your profit?
No, 100.
Why is the $150,000 not your profit?
Because 50,000 is your actual investment.
50,000 is your actual investment, right?
Yeah.
Now
that's your capital.
Okay, fine. Oh, thank you, Holy Spirit. This is a good one. You guys get this one now, right? But you bought this house and then you did an upgrade of $10,000.
60,000.
Now, when you say your house 150, how much is your total investment on your house?
60,000.
60,000.
50,000.
So how much is your profit?
90,000.
90,000.
You guys are getting it now?
It's straightforward the way you are putting it, but that is not the exams will do.
Yeah, but that is why I'm using this, so that you take it into the context of this. Is the same principle.
Okay.
You got this. If you get the house, you will get this. Okay? So now you did an upgrade. Now, another upgrade came up. You didn't have money. You brought a contractor. Contractor said, for this, you need to spend 20,000. You didn't have 20,000. You went to RBC. RBC gave you 20,000. But RBC charged you interest on that 20,000.
Of course.
And then let's say the total interest you pay to RBC is 5,000. So when you sell your house 150, what is your total investment on this house?
75.
60 plus 25, 85,000. 85,000.
85.
60. Yeah, 85,000. Yeah, plus 85.
85,000. The upgrade, the 5,000, the contractor money, everything together, 85,000.
Mm-hmm. But when it comes to insurance, because it's a policy loan, okay? So the 20,000 from RBC did not come from your pocket. You are only paying the interest, okay? So you are only, you cannot add the 20,000 because you did not expend that one from your pocket. You get it?
Yeah.
Yes.
yes.
So what the one you spent from your pocket, tell me how much was that?
65,000.
65,000. Exactly. So now bring that into this. That your 50,000 purchase of the house is the total amount of ACB you've contributed into your policy. You see, when you see ACB, is cumulative interest you've paid over time. It's cumulative premium you've paid over time. Okay?
Yeah.
And then, just like the upgrade you did in the house, right? Because let's say it's participating whole life, the participating whole life, they gave you 10,000. Instead of they gave you 1,000, you put it back into it, you will add it to it.
So your ACB.
To the ACB.
So your ACB.
Yeah. Okay.
Okay? Right? So, but now, in that same your house, the total expense now, we have 65,000, right? And then, let's say you were able to collect rent on the house to the tune of 5,000. So that rent, you've collected this cash, is not part of your expenses anymore, right? So we will have to deduct the rent you collected, or Abi?
Yes. That's adjusted cost
yes.
benefit.
Yes, we will remove the rent because somebody, is again, somebody came, they stayed for a few days, they pay you 5,000. So initially your total investment into the house was 65,000. That was the money you spent out of pocket. But because somebody came and stayed and pay you 5,000, that one have reduced your expenses now to how much? 60,000. So now you sold the house for 150. So your profit will be how much?
90.
90. Do we get it now, guys?
Yes.
Oh.
Yes.
Okay. So now that you get it, so just know that when it comes to policy loan, if you borrow money from the bank, the interest that you pay, you add it to your adjusted cost basis. Okay? However, the amount of policy loan taken against the cash surrender value of the policy, the section of taxation. This one, we'll do that one in taxation section, okay? Now, the next thing is policy repayment. The amount of policy loan repayment to the exact of excess of the policy gain reported. Okay. At least now you guys have gotten this one, right?
Yes.
Can you give us one more question or two on what you've just explained?
Oh my goodness. Okay, for those of you in the class that have understood, who is going to explain?
Okay, let me.
Policy gain, there's adjusted cost, there's cash surrender value. It's like you are using cash surrender minus adjusted cost.
So your cash surrender value is your, look at it as the proceed. Cash surrender value is the proceed of the life insurance.
Yes, yes.
Okay, your cash surrender value is the proceed of your life insurance.
Yes.
The adjusted cost basis is the total amount of you've contributed into the policy over time.
Yes.
And then
policy gain.
Policy gain.
Yeah, the policy gain is your proceed, the proceed of the policy minus your adjusted cost basis. That's your policy gain.
What's the difference between cash surrender value and policy gain? They look so.
Okay, so your cash surrender value is the amount you sold your house, 150 that you sold your house.
So that's the coverage. That's the coverage of the.
No, it's not your face amount. It's not your coverage. That's cash value.
Okay.
Okay. The cash surrender value is the proceed of your policy. The adjusted cost basis is the total amount of premium paid over time.
Okay.
Now, the total amount of premium paid over time, if you minus it from the cash surrender value, that'll be your policy gain.
Policy gain. Okay.
All right. Now, so when we are talking about ACB, adjusted cost basis, okay? Adjusted cost basis formula, we have two formulas for adjusted cost basis. Why? Because we have the policy that we call the grandfather policy. Those are the policy before December 1st, 1982. Okay, so the way I remember this date is, think about any special event that happens in your life around December 1st, 1982. So that you know, okay, 1982, December 1st. So that you can, use that one to remind yourself.
Maybe
and then, so, and then
I was
the other one.
my birth month, my birth year, 1982. So.
Okay, so good
even
for you.
When I was doing my exam, then I always put that in my head.
Then the second one, okay, what happened was that you see this this grandfather policy, and there are still some people that still have this grandfather policy. Okay, very important, because it will be demonic to go and cancel any grandfather policy for anybody. You have done that person bad thing, bad evil. Because after this December 1st of 1982, it's like there's a scale that fell off CRA eyes. And they woke up and say, how can we allow these people to be making so much money? We are going to make sure we make them pay more in taxes. Then they changed the formula. Okay? Now, for the grandfather policy, let me show you. Premium, let's say the face amount is 100,000, premium is 25,000, the cash surrender value is 40,000. Okay? Now, okay, let me give you guys this, and then let's do the calculation. Let me see. That's basic cost of the policy tax purposes. I'm looking for the formula for the grandfather policy. Okay, let me give you guys this one. All right? Are you there?
Yeah.
So, for the grandfather policy, to determine their own adjusted cost basis is very straightforward. Total premium paid added together. That is it. So if they collect dividend, they didn't collect any dividend, they take policy loan, there's no policy loan, CRA was not looking into all that. You see that? So for the grandfather policies, it's very straightforward. You take their the policy gain is equal to cash surrender value minus ACB. And ACB was simply the total of premium paid over time. We get it now? Then,
again.
The grandfather policy. Which policy are the grandfather policy? Policy before what date? Tell me.
December 1st, 1982.
19 what?
82.
82, good. So, those grandfather policy, the policy gain is equal to cash surrender value minus ACB.
Okay.
That is policy gain.
Okay.
And for those policy, the ACB is simply the total amount of premium paid over period. That's it. Nothing, no more, no less. So if they were paying $100 for 20 years, their ACB is 24,000. If their cash surrender value is 50,000, it's simply 50,000 minus 24,000. You get their policy gain. Everybody rest. Okay? However, after that, when the scale finished falling from the eyes of CRA, guess what they did? So any policy after December 2nd, 1982. So the other one is before December 1st, 1982. Then the second one is anything after December 2nd, 1982. What is this thing? The policy gain is equal to cash surrender value minus ACB. Okay? And the ACB, now there's a formula for ACB. ACB now has its own mini cubicle. So to get your ACB, is premium paid minus dividend received minus net cost of pure insurance to get your ACB.
So how do you explain that?
Don't worry, we'll unpack it now. Okay? Jeremy. Okay.
Net cost of insurance. The formula. Okay.
Okay.
Of
so now,
okay,
so now you want to write it down. Okay, so now ACB now has its own formula now. We have formula for ACB, which is equal to total premium paid minus dividend received minus net cost of pure insurance. Okay, so net cost of pure insurance, NCPI. Okay, so many a times they'll give you your NCPI. If they don't give you your NCPI in your text, for those of you using Remick or Oliver, they'll give you formula for NCPI there. Okay. Oops. This thing just turned off. Oh shoot. Okay. I thought I lost you guys. Okay. So again, total premium paid. Let's say you paid 20,000 over time. You minus, you remember when I told you guys dividend, right? Any dividend received, you have to minus it from your ACB. So if you see dividend, like you bought a property, you're able to rent it out and you get some money back, okay? So that dividend, if you receive dividend, let's say you got dividend of 5,000, you minus it, okay? Now, then also minus net cost of pure insurance. Yeah. Okay, so this is how you get your formula for ACB. But the objective of this class is this explanation I've given you guys, so that when you go back into your text and you see on this concept, now you know what they are going after. You know that the reason why is CRA doing this is just so they collect more taxes. It's just so they collect more taxes. Look at it this way. You that bought the house 50,000, right? You did an upgrade 10,000. Is that not 60,000?
Yeah.
You rented the house. You collected rent, right? So if they allow you to add that rent, so that would be that's additional 10,000, make it 70, right? So if you sell the house 150 and you deduct 70 plus one from 150, it means your profit will be 80,000. But Bessiah said, no, how can we allow this to be added? No, he has taken the money, right? So instead of adding this 10,000 to the 60,000, you have to deduct the 10,000 from the 60,000, remaining 50,000. And because this is now 50,000, you deduct it from 150, it means your profit now is 100,000. Now you are paying what? Taxes. More, because your profit is more. And that's why I said, when your ACB is higher, your profit will be lower and your taxes will be lower. So when you get into, when you are solving all these things, you are going to see all this, okay? But now you understand the concept, you know what it stands for, and you know what is testing, and you know the grandfather policy, and then the policy post December 2nd of 1982. Okay? All right, so we have a taxation of exempt versus non-exempt. An insurance policy with investment value less than the maximum allowed MTAR value and growth. Okay, so this exempt test is also talking about the exempt test increase that I've talked about. You see, exempt test increase is like a gatekeeper, okay? Because there's what we call the MTAR rule. The MTAR rule is the rule that is put in place by the insurance company to ensure that whenever an investment growth surpasses that rule, it becomes exposed to taxation. And that is why to keep the kids against falling into that, that's why we have the exempt test increase put in place, okay? So there's another concept that I want you guys to also bear in mind is the concept of anti-dump rule, okay? So the anti-dump rule prevents policyholder from making large lump sum deposits into their policy, okay? After its 7th year, in the 10th year and every year towards, so that the cash value will be compared to cash, the cash value will be compared to the CV in the 7th year or wherever. Anyways, basically, what the anti-dump rule try to guide against is situation whereby people wants to put excess amount of money into their policy. Okay, there are some restrictions in place that prevent them from doing that, because insurance policy is a massive tools that people can use to run away from taxes. All right. And CRA from time to time try to put, some rules in place to prevent people from doing that. Okay, and this anti-dump rules is one of. All right. Taxation situations. Okay, so these are just basic calculations of the different taxes, proceeds, dispositions, and everything that this is an example of everything we'll be trying to unpack since, okay? So, and these are the formulas, okay? For those of you who's using, is it Remick or Oliver? there's a formula sheet, I think at the beginning of your study materials, okay? So you are going to see this formula for ACB in that sheet, all right? And now that you understand the concept, you'll be able to solve, the ACB related questions that you come across, all right? All right, so now next we are going into absolute assignment or transfer of ownership. Recall at the beginning of this class, we talked about circumstances that could trigger taxation of policies. We talked about, when you assign a policy, absolute assignment is when you transfer the ownership of your policy. That is not very common here in Canada. However, in US, that is very, very common in US, whereby people own policy, after some time they can even sell it. Okay. Now, then to release to a related person or parties with common interest, this absolute transfer can be, to a person at non-arm's length, okay, or to the parties with common interest, all right? So a transfer as a gift, this transfer, they can be transferred as a gift, but then again, I don't know why they're making us to study this. This is not a practice here in Canada. And then a policy can be assigned or transferred from a couple to a corporation or from a corporation, all right? And then a policy can also be transferred to a joint owner. But basically, you just need to understand that policy ownership can be transferred, okay? Now, don't mix this up with life insured, okay? This can only be possible where the life insured is different from policy owner. Okay. Now, when we do all this transfer of policy, there's an example here. Let me read it for you guys. Robert is the owner of what? Universal Life. He's terminally ill. Joanna, his spouse, is the annuitant, okay? Now, if Joanna dies, Robert gets the death benefit, all right? Then the ACB, which is adjusted cost basis, is 34,000, and the cash surrender value is 61,000. Now, Robert transferred to his brother, Jim, a policy gain of 61,000 minus 34,000, which is 27,000. So Robert pays tax on the transfer, all right? So Jim's ACB is this. So if a policy is transferred to another person, all right, it depends on, at the time of the transfer, what the cash value is, all right? And then that determines who pays, okay, the taxes, all right? So like in this illustration, Robert owns a UL. Okay, Robert is the owner of the UL policy, and Robert is terminally ill. Joanna is the spouse, which is the annuitant. If Joanna dies, Robert gets the death benefits. So in other words, Joanna is the life insured. Okay, and then if Joanna dies, Robert, who is the policy owner, gets the death benefits. So in this case, the adjusted cost basis they gave us here is 34,000, and the cash surrender value is 61,000. So there's a policy gain of how much? 61,000 minus 34,000. How much is that? 61,000 less
27.
Okay. 37 or 27?
27.
Okay, 27. All right. So Robert pays the taxes, okay, on the 27,000. All right. Now, if he transferred the policy to Jim, So it means that Jim's total ACB will be 61,000 because Jim received 61,000 value of policy because he wasn't the one that made any contribution prior. Did you get it now?
So Jim is going to get the ACB and the profit.
Of the 61,000. That's the total package of the policy, which is 61,000. Now, for Jim, the 61,000 is not profit. That is the total, value of the policy that is coming to him.
So it now became that's 1,000 now became Jim's ACB.
ACB, exactly.
Will Jim pay tax on it?
On that 61,000, they didn't mention anything about. No, if can't pay because Robert have already paid taxes on the difference of 27,000. Okay, so now this policy now will be monitored in Jim's hands. So depending on the growth from this point forward, will determine how much of taxes Jimmy will have to pay. All right.
Okay.
Assigning policy continues. Okay, this is another example, which is similar to that one. We don't need to this thing. So now, what are the strategies that can be used? Oh my God, time is far gone, man. Okay, let me see a reasonable place we can. Okay, let's finish this chapter 7. Okay, because time is far gone and many of us are going to work tomorrow. Okay, what are the different strategies that we can use, okay, when it comes to taxation of our policies? All right, using policy as a collateral assignment is one of the strategies we can use, okay, in order not to be slammed with significant taxes when taking money out of policy. So how does this work? Policy owner can obtain a loan from the bank using the cash surrender value as collateral. Okay, banks becomes the beneficiary of the debt benefit for loan amount to the loan amount. If policy owner defaults on the loan, banks can surrender the policy and obtain the cash surrender value. If owner dies, the bank gets loan portion of the debt benefit and no tax payable. Policy owner can declare portion of the premium as business expenses deductible in loans if it is used for business. So what is this talking about? So for example, instead of taking the money directly from your cash surrender value and be slammed taxes on it, another strategy that can be used is to also use what we call policy collateral assignment. Collateral assignment is where you take your policy to the bank. Let's say you have 150,000 cash surrender value in your policy. You take that to the bank, assign the policy to the bank. Bank gives you 150. So that 150, you are not going to be paying any single tax on that 150. Okay? You are not going to pay any single tax on that 150. However, for the bank to give you the 150, bank may charge you some interest, which is okay. You pay the interest, but just know that from the moment you assign the policy to the bank becomes the temporal owner of the policy. When you return the 150, the bank will return the owner, that is the assignment of the policy to you. But if the person passes away, okay, while the person is still owing the bank the 150, what will happen is that if the debt benefit is $1 million, the bank will receive their 150 and then the remaining 850 will go to the beneficiary of the policy. So that's the way the policy assignment works. And this is great because debt benefit pays 0 taxes. So this person is able to take the 150 without paying taxes, only pay just the interest to the bank. All right? Okay. So again, and then another strategies that one can use when it comes to taxation of policy is charitable donations. Okay. When we give to charity, there's a way a charitable donations can be structured, okay, such that it will be beneficial. Someone that is still alive can benefit by, like committing to donate the part of their death benefit towards charity. But that one is a straightforward concept that we can read in our textbook, all right? Managing your taxes upon death. Well, salary of the person in the year of death, taxes are due when somebody, there are several taxes that will be due when somebody passes away. Okay, and that is what insurance policy helps to address to a great extent. For example, somebody that is working that receives salary, when the person passes away, like I told everybody yesterday, the final taxes will have to be filed, and there will be taxes due upon that. Okay, and then there will be taxes on RRSP, on registered retirement income form, and also there might be some estate triggered taxes as well. There might be probate fees. See, all these things are things that when we understand this concept and how they work, then we'll be able to guide our clients, okay, the different strategies that they can start using now, so that when the time comes, they will have the resources in place to address all these taxes that will be triggered upon the passes of an individual. I think we have to stop there for tonight. All right. Any question before we go?
Yeah, it's been a wonderful night. I've joined the group
tomorrow.
I've joined the group, so I will want, like you promised, I want the chapter 1 to 6 that you discussed yesterday.
Yes, I'll send that. Yes, but tomorrow we will not be having any team meeting. So we come in at 7 p.m. Mountain Time, 9 p.m. Eastern. We'll go straight into the remaining part of the text before we do the Q&A. All right. Thank you, everyone, and have a good night rest.